Hi all, the options market is changing again, and this is the biggest change in my opinion since November 2024 when Bank Nifty weekly options was stopped. Now, this time Nifty options are changing from the iconic Thursday expiry to a Tuesday cycle starting from this upcoming September 2nd weekly expiry. So while all of these changes are happening around us, I wanted to come in front of you and discuss what all are the recent changes that have happened in the market. Why is all of this happening? Yes, there is an additional 2025 SEBI report also that I would like to share here. Then I would like to share my thoughts on the larger crackdown of the government on options trading. What could be the future of the stock market and options trading in India? So yes, welcome all to another market feed video. This is Ajay Ajith. Let's get started. Let's have a quick recap, shall we? In September of 2024, SEBI came out with a report saying the analysis of profit and loss in the equity derivatives segment. And they did a detailed study on financial year 22, 23 and 24 and said that 91% of options traders in India are losing money. At the time of the report, SEBI said that retail traders lost more than 74,000 crores in FY24. And from there, we have started seeing more things happening. SEBI came out with a detailed list of items that they'll be doing or changes they'll be making in the Indian market, including rationalization of weekly options. We also saw that SEBI came out with rules to increase the minimum options trading contract sizes, right? And because of that, the lot sizes and the entry barrier into the options market also increased. And all these changes started getting implemented from November 2024. In fact, in November itself of last year, we saw Bank Nifty, Fin Nifty and all other weekly expiries going away. SEBI said that only one weekly expiry per exchange, that is what SEBI said. And starting from January, we saw the options trading lots, the contract sizes also going up. And just last month, SEBI came out against Jane Street, a huge player in the Indian options category, and called them out against their deceptive trading practices and their trading strategies which they were using to trick or manipulate the Indian markets. So after all of this happens, you think SEBI might be done, that they would be closer to achieving their goal. But that is where you would be wrong, because in the current FY25 report that SEBI has published, you can see that still 91% of option traders are losing money in India. And guess what? The amount lost has gone up from 71,000 crores to more than 1 lakh crore rupees being lost by options traders. So now we understood what all happened in the options market over the last 1 year. Now let's try to analyze what could happen over the next 1 year. Come, let's do that. So this is a SEBI report that we were discussing just now. So it clearly says that more than 1 lakh crore was lost by retail traders, individual traders in FY25, up from 74,800 crores in FY24. You can see that over the years, this number has only been increasing and increasing. 40,000, 65,000, 75,000 and the biggest jump here to more than 1 lakh crore rupees lost by Indian traders. So even though the headline number is that 1 lakh crore has been lost by retail F&O traders in 2025, we also have to look into few key facts that have changed since SEBI introduced all of these new rules in the options market. So the first one is, after all of these rule changes, index options turnover year on year is down by 9% comparing to whatever is a period from December to March of the previous year. So SEBI took the data from December 2024 to May 2025 and found out that index options turnover has in fact reduced by 9% year on year. I think it would be the first time in at least 5-6 years where the index option turnover is reducing instead of increasing. They also said that the number of unique individual investors trading in the EDS, equity derivative segment, went down by 20% compared to the previous years. It is still up from comparing to 2 years ago, but at least comparing to last year, the number is down, which is overall positive for SEBI, who was trying to take all of these actions. So I would like to wrap up this segment by discussing this one last table. So you can see here that the people or individuals trading with 10,000 rupees, less than 10,000 rupees, that was the highest growing or the fastest growing segment in all of India. right? Individuals trading with less than 10,000 rupees, that was increasing at an exponential pace in the Indian options market. I can clearly call them out to be gamblers in the Indian options market. And you can see one positive thing that has happened here is that the largest degrowth in number of traders is happening below 1 lakh rupees. Okay. SEBI is clearly saying that it is seen that traders with turnover less than 1 lakh rupees witness the highest degrowth compared to previous year. That is definitely a good sign. It says that the market is becoming healthy again. It says that random gamblers are getting pushed out of the market, and large heavyweights, people who still have capital of at least 1 lakh. In my opinion, if you don't have 1 lakh, you should not even be trading in the F&O segment. If you have this 1 lakh and you're here, yes, you can still continue to trade. SEBI still has all the options open and available for you. And you can see that the particular segment we're talking about here is not that affected at all. In fact, you can see that the higher the capital goes, that is 10 lakh to 1 crore, you can see that there is very less people moving out from the market, only 14% degrowth compared to last year. And as the number goes up, the percentage of people churning from the options market again reduces. So after this report came out, there are additional hints at what all SEBI could be doing next to control the equity option segment. So what all are they? One is passing exams or increasing the minimum barrier once again to enter into the F&O world. Two is going into a world where there are no longer any weekly expiries for an exchange. There are only monthly expiries available. And three, trying to promote the cash market, because even in this report, SEBI is saying that the cash market has been recovering really well, and the gap between the cash market and the equity derivative segment, even though it is high, it is slightly reducing. That means the cash market is growing at a larger CAGR. And that is where we should take a step back and look at why is SEBI doing all of this. And that can help us try to analyze and predict the future also for the option segment. So the major reason why SEBI has been attacking options traders like anything is definitely pressure from the union government. So the government saw that a lot of money was being lost by small retail individual traders, and combining all of this money, the amount itself was growing out to be large. That is more than 70,000 crores being lost last year, more than 1 lakh crore rupees being lost in FY25. And where is all of this money going? A lot of this individual retail money was going into the hands of FIIs or foreign institutional investors like Jane Street, and that is what the government is trying to stop. So on one side, the government does not want the normal people of the country to lose a lot of money. On the second side, the government does not want the money to be flowing out of the country. So you can see clearly that there is a pattern here. After the options market, where did a lot of this money start flowing into? Again, if you think that if people are denied the opportunity to enter into options, they won't go anywhere else, I would say you're wrong. I would say a lot of money started flowing into fantasy gaming apps or online money games, as the government calls it. So you can see that online money game platforms has been banned by the government last week. And when retailers started searching for more and more avenues after getting out of options trading, they went into this online gambling or this online sports betting. After that, what is next? I think the government is on a mission here. So first, options was attacked. There was some positive signs there, at least a small retail traders getting out of the market. Now, next, this online money gaming apps going out. And third, I think, again, crypto is going to come under a lot of fire. So if you're someone trading in crypto options, make sure you have that in mind. It could be an area where the government is going to target next, because a lot of retail investors, after going out from options trading in Nifty and Bank Nifty, have gone into options trading in crypto. I know all of you know the platforms that YouTubers have been promoting here, and definitely the government is trying to or will try to go against all of them in the upcoming 6 to 12 months. That is my thought here. So what we can understand from the actions of the government and even SEBI going after these people who are gambling away their money, we can clearly see that the market that they're trying to reach is retailers putting in less money than 10,000 1 lakh rupees. And if you're a serious option trader with capital of 2, 3, 4 lakhs or even higher, you should not be that severely affected with all of the even further changes that are happening around us, which is that weekly options will again start going away and we'll see only monthly options. Again, things will start evolving there. If you have the capital, you don't have to worry, is my opinion, where new exchanges will start coming in. Already there are new 2 exchanges being planned, wherein you'll be seeing 1 weekly expiry per exchange, right? So if the first week of the month you'll have NSE's monthly expiry, you'll have BSE's monthly expiry happening on the second week, and then on the third and the fourth week, new exchanges are also coming up. So the larger traded volume should remain the same. Again, the liquidity should remain the same. That is not something I'm concerned of, and you should also not be if you're having a slightly higher capital. And just like this table suggests, CMS cash market is growing at a really healthy pace. That is 25% CAGR is what is being observed in the cash market now, slightly more than even the options market. So you can see that between FY22 and 23, the cash market had actually gone down. The turnover there had gone down from 72,000 crores to 57,000 crores. But you can see that it's recovering really fast, and that is something the regulator would also love to see. So I think that the cash market will be promoted much more in the upcoming years, and a lot of liquidity, a lot of trading action, a lot of really good opportunities will start coming for traders. Not for investors, because the markets are at crazy valuations now. For traders, a lot more liquidity and a lot more good trades will start coming in the cash market very, very soon. So that is what I'm personally excited about. So those are my thoughts on options trading in India in 2025. You can clearly see that whatever the government is trying to do is working. And if you're an options trader with capital of more than 2 lakh, 3 lakh, 4 lakh, you don't have to be worried about that much. And just to give a heads up here, so what I'm showing on screen is the last multiple weeks of market feeds trades here. You can see that they're break even or positive. So the opportunities in the market, in the options market, is still continuing, especially after Jane Street got kicked out from the market. And if you also want to learn more about automating your trades, make sure you click on the link that I've given in the description and in the pinned comment. This is Ajay Ajith signing off. See you all again. Bye bye.